George, what does it mean to be defensive as an investor in today's market, and how has that definition evolved?
Well, it's actually evolved very much over the past few decades. In the past, your only alternatives were really to go into assets with lower expected returns like fixed income or potentially low volatility equities. Now, investors have access to many more types of securities that can give you lots of protection with much more defined outcomes. So one great example of that is the buffered ETF that has a hard cap on the downside. However, in order to get that hard cap, you typically give up a little bit of upside participation.
Why would an investor want to give up that upside participation, especially when the last 3 years in the markets, in the publicly traded markets, have done so well?
Well, that is a great question. There's many different reasons. Much of finance is based on having lots and lots of trials. So you can say over the next 100 or the next 1,000 outcomes, this is going to be a better example, or this is going to get you a better return. The problem is there are many people that don't have 1,000 outcomes, right? If you're pre-retirement or in retirement, if you're saving for a very fixed goal and the cost of missing that goal is prohibitive, then there are many scenarios where you want to have something that gets you some upside, but really protects you from a strong drawdown.
But how do you guard against sacrificing long-term growth when people keep talking about longevity risk?
These also help you design portfolios, because one of the biggest risks for people that are either in retirement or in the early or just before retirement is really the cost of a large drawdown. So avoiding a large drawdown, even if you give up a little bit on the upside, really increases the overall longevity of your portfolio. So it really is an excellent tool for a certain type of demographic or people with certain types of investment needs.
Okay, so which defensive strategies are best for investors right now?
There are a number of great options. One of them is the buffered ETF, and the buffered ETFs, again, will give you a specific type of outcome with a particular type of floor on the return that you're going to get. It's basically going to take off the tails. So it's going to take off the very negative tails. It's also going to take off some of the very positive tails. There are also products where you can get a level of enhanced income. So like a covered call strategy that perhaps you can participate by having some equity return, but then also by selling covered calls within the strategy, that gives you an additional layer of income, which again plays very well into people that are looking to design long-term portfolios.
And then finally, can you dig a little bit deeper into how buffered ETFs work so people aren't scared of them?
Sure. So buffered ETFs are built entirely out of options, and it's really a put collar or a put spread that gives you the predictable type of outcome. And then on top of that, there's typically a couple of additional option legs that will give you the overall upside to the market. So it is purely derivative. However, the thing to remember is that these strategies have been around for many years. They're not new. They were often sold by banks to high net worth clients. It's really been a democratization of this type of investment that has really made them much broader. And this category in the market is actually one of the fastest growing categories in this segment.
All right, well, thanks for coming on and talking about it.
Thank you very much.